talk actually will be my next blog. This is the dry run for my next blog. The title I editorialized a bit called QEs, which is quantitative ease, which is the Federal Reserve expression for mega increase in the balance sheet of the Fed, quantitative ease. In the good old days, even as recently as 5 years ago, an annual increase in the Federal Reserve balance sheet was something of the order of 30 to 40 billion a year. Now we're running $1 trillion a year as the base number. So that's a 33 or 35% 35 times increase in the money supply, given the extreme events that exist in our economy today, and I see no end to it. Where the QEs lead to, which is the second item in my list here, it's called currency wars, and that's where I'm going to focus the attention today, because we now have a new dynamic and a new development occurring where we're not only increasing our money supply, but we're forcing it on other countries as well, and the total sum of the money supply increases across the world are some multiple of our money supply increase. So you see where that is likely to go. In fact, that's where we'll start to nibble on the possibilities of where that leads us to. And then we also had, I guess at the time Christine asked me for a title, that previous week we had this new flap in the same, along the same genre of events. It's called the $1 trillion platinum coin. And I wanted to work that, grapple with that to see what it does. And it's actually it's a minor variation on the theme of what they're already doing, which is monetizing. And I'll go through the balance sheet of it very quickly. And then as your intuition leads you and should lead you to, if anyone has microeconomics intuition, a large supply of something means the price goes down. So if we're going to have a great deal of money increase, it probably is going to lead to devaluation of some sort in some dimension against some other goods. So that's what I'll be talking a little bit about today. Okay. We have a problem. We have a mega problem. The mega problem right now is the deficit. I don't have to tell any of you that. We've just been through the fiscal cliff discussion, and basically we haven't really done anything to narrow it down, even for this year or the next few years, let alone for the next 75 years. The numbers are staggering. There's so many ways I could put it to you. The third item on this PowerPoint is the fiscal gap, which is estimated not by the CBO, but by some economists from Bloomberg, and actually a local economist, Scott Burns, who writes in actually the Statesman as well as the Dallas Morning News. He's syndicated nationally. Basically, they took the CBO numbers, they extrapolated it forward, did a present value back to the present, and what they have found, the cumulative unrecognized deficits over the next 75 years, which is the implication of all our legislation of spending and taxation, and projecting even healthy growth rates of the economy. The number is staggering. The present value of the whole ball of wax is $225 trillion. Compare that to today's flow rate of income of $15 trillion. So it's a number that is so staggering. In fact, the current year, the unrecognized accumulation of liabilities, which corporate America has to recognize, but the government hides, is 11 trillion. We're funding 1.2 trillion. So what's being funded in the debt markets is a very, very small proportion of what's coming down in the future. So I don't care how you measure it, these are imaginary numbers. I guess you'd call them mathematics. It just can't be funded. So the question is what's going to happen as a result of all that, and certainly there has been no headway whatsoever with regard to confronting this. And again, yesterday they put off the thought of reducing spending yet again. So this ends up being the U.S. debt projections, and this is put out by the Congressional Budget Office, and at least in a little bit of a moment of being candid. This is the ratio of debt to income, and here we are at 2010, and it goes out to 2080. So that is about the 75-year period, and that is projected to be held by the public, i.e. when the government runs a deficit, they need to sell that debt to private individuals. And it gets us to a 400% debt-to-income ratio. And these numbers are not really real in the sense that we're never going to get to that level of income that they imply, because as a Congressional Budget Office merely extrapolates, and they don't make any economic judgments and understand that the high levels of debt slow your growth rate of income, so the ratios grow even faster. It's not affordable. It's 4 to 1. This is basically buying a $1 million house for the government in addition to your own mortgage and trying to debt service both of them simultaneously. We're not going to get there. There's no way we can get there. As a matter of fact, another number that tells me that it's mission impossible is that the margin, the annual public purchases of government debt is 5 times, currently, 5 times the annual total savings in the US. 5 times. So it's not being sold to the public. That's a fiction. It can't be sold to the public, which is really where we get into the QEs and the currency wars, et cetera. Basically, you know, in a sense, it's a winner's curse if we do sell that debt, because if we do sell that debt, we end up having the debt service. And the debt service is astronomical. As you can see, the top line is total spending, and the gap between the colored section, which is spending on things like defense, Medicare, Medicaid, et cetera. The gap, the rising wedge, is the interest payments. So if indeed it is sold, if mission impossible does occur, we can't afford the interest expense. So obviously what we need, we're getting up to 45% of GDP. The debt service in the out years gets to 25% of GDP. And the government in total, just to give you some idea, the total take of the US government from the income stream last year was 15%. So, I mean, these are imaginary numbers. All right, so we're now down to the new mission of the government, and that is costless financing option. It can't be financed. It's a pure fiction. So we have a couple options, and here are the 4 options, and it's monetary trickery of some sort. And here are the 4 leading candidates. The first one is to bring in the Federal Reserve as a subsidiary of government to do their thing, which the law intended them not to do, which is to be independent and serve as a discipline to the US government. But nonetheless, they're being called in to run the printing press and buy the Treasury debt. Very explicitly in Japan, I don't know if you've noticed in the last month or so, the central bank chairman indeed tried to be independent. You set up an independent central bank as a disciplinary force on government, that indeed you can't turn to your own private bank to do your financing when you can't sell it on the market. And I think just yesterday, the central bank chairman in Japan offered his resignation. So basically, if you either go along with it, you resign, or in the case of Japan, the incoming prime minister rather, indicated the laws will be changed so that it will be, indeed, the Bank of Japan will be back under the Treasury Department. As a matter of fact, the way we used to handle it in the United States or other countries is the Secretary of the Treasury, who has to raise the money, also is the central bank chairman. So on one hand, he prints the money, and on the other pocket, he buys it. It's all under the same roof. So one possibility is Federal Reserve monetization of Treasury debt. It is now taking place. I did one of these alumni lectures, I guess it was February of 3 years ago. I think the title was Sovereign Debt is the New Subprime. And all the outrageous things I pointed to, and of course, I was put into the category of the lunatic fringe. It's now happening to the extent of $1 trillion a year. It's very quickly, 3 years later, it's happening. So we'll go through what happens under monetization. The second costless financing is the $1 trillion coin, and it's trickery in a sense. And I'll show you how easy it is, how incredibly easy it is. Under law, how incredibly easy it is to have the central bank finance the deficit. The third possibility, which is a very interesting one that I wrote a blog about last year, which has to do with Treasury currency. We had the same problem in the Civil War. If you can think about it, we did not yet have the the amendment to the Constitution that allowed for the income tax, the federal income tax. So you have this mega war, and certainly I do recommend everyone to see Lincoln, which gives you some incredible feel and understanding of the extent of that war and the stresses associated with it, one of which obviously was financial when you don't have an income tax. And so one of the things they did in the Civil War was the Treasury printed money. And the first use of the printed money was to pay the soldiers who were on the verge of deserting since they hadn't been paid in quite some time. We could easily go back to that. It's an issue of law. It's an issue of which option do you use, which one's smoother that goes down in the press with least flap. The fourth possibility is silver certificates, and the legislation still exists, and some of you probably still have silver certificates. All right, so let me get to the first one, the Fed monetization. It's very simple. In the upper left is the U.S. Treasury balance sheet. And since you're all McCombs graduates, I feel I can do balance sheets. With another audience, I wouldn't be able to do that, but unfortunately, I can cut right to it. The Treasury on the left-hand side, at the margin, issues Ts. They could be T-bills, T-bonds, et cetera, with different characterization depending on the maturity. And they have to sell this. You can't sell it in the public market. It's way beyond the demand of the public market. And so basically you sell it to the central bank, the Federal Reserve. The Federal Reserve has just gone through these dog and pony show to indicate and justify why they did it. It was all justified based on current law, which states that basically the Federal Reserve has to be concerned about unemployment. And in the QE statement last, I think, September or October by Bernanke, I believe he mentioned unemployment 32 times. And he never mentioned the reason for the QEs to finance the U.S. government. But so you have to justify it under current law. And he did it that way, and that's what the law says. So the Fed, at the margin, these days, the Treasury is issuing, last year, I think it's 1.2 trillion. The Fed is buying 500 billion, a little less than half of it directly. I say directly, it does go through a middleman called the government bond dealers to make it legal. So the balance sheet at the end of the day is the asset purchased by the Fed is the Treasury. The Treasury sold by the Treasury, 2 blocks away, the Fed buys it, puts it in their portfolio, pays for it in cash. And I know there's a lot of discussion of whether it's really cash or electronic money, but if it's electronic money, it's a claim on cash. They don't actually print the currency and pay it and count out $1 trillion in bills, but it's all claims on dollars. So basically, you then put the two together, and after the Fed delivers the currency or the checks, now Treasury has the capability of spending and covering our current deficit. So down below, underneath it, is the consolidated balance sheet where you put this big spender together with its in-house bank financing, and basically the debt disappears, which is exactly what they wanted to do. They want it to disappear, not held by the public, but is held by some other government agency. What ends up being the consolidated outcome for the U.S. is the currency is outstanding on the right-hand side, or the liability of the consolidated balance sheet, and on the left-hand side of what assets are left, which is, I think, interesting and worth noting, is that the only fixed asset that comes out of this whole operation is the extent to which current government spending is actually buying some kind of physical equipment that hopefully has some impact on future incomes and revenue streams so they can continue to produce and generate income of which they're the beneficiary. It turns out, I was trying to put a quick number on it, my guess would be that the remaining capital purchased on the balance sheet of the government, and I call it the IH-35s, the Interstate Highway 35s. In other words, in quotes, it's the whole system, it's all the government infrastructure, et cetera, et cetera. It ends up being less than 1/3 of the balance sheet. So what you see is happening, that investors are noting, that every day this transaction occurs, the U.S. government goes further and further into insolvency. The debt grows, but the assets grow at a much slower rate. Most of the spending is consumables, i.e. transfer payments for Social Security, for unemployment, et cetera, et cetera. So most of the spending is consumed. What's left on the residual of the balance sheet are the relatively few income-producing assets. but the debt is there. Excuse me, the currency is here. Now, short term, this has a benefit. It keeps the economy going in the sense that we have $1 trillion federal deficit that adds net to the income stream $1 trillion. We have a $15 trillion economy. Net, we're actually, that last year was $1.2 trillion. Net impact of the Treasury deficit. Now, fourth quarter last year, the numbers just came out for 12. The real GDP growth rate was -0.5. Can you imagine where the economy would be without this? Without this, it amounts to a 9% injection into the income stream from the federal government as a result of this. You take that 9% out, without question, you call it depression, without a question. So basically, I guess the good news is we're accumulating debt, which becomes a long-run problem, but in the short term, we're muddling through with only losing a 0.5% growth rate. So that's one of the mystically magical, wonderful things about having your own printing press. I wish I had one for my debt. You all wish you had one. So the first thing is the debt goes away and you have the income and you can keep spending. The other is the interest is largely negated because to the extent that the Fed owns those treasuries, indeed they are paid interest, which you and I pay taxes. The interest, our taxes go to the government. They pay interest to the Fed. The Fed subtracts its cost of operations and rebates the rest to the Treasury. So basically, last year was $89 billion was rebated back. So basically, the cost, the interest carry goes away, and the debt goes away. So this is mystically wonderful financing as far as you're concerned if you live in the White House. The debt got taken care of. We never had to confront the market. We didn't have to reveal the extent of our indebtedness, et cetera, et cetera. And on the face of it, things appear to be, as compared to the Great Recession, well, only a half-point negative is not bad. So on the face of it, it doesn't look terribly bad. But the exploding interest expense that took down Greek debt will not happen as long as we can have our own central bank purchase the debt. Now, what separates the U.S. from these other debt countries that we hear about, in the case of Greece, Argentina, and California, for example, they sold their debt denominated in a currency for which they did not have the printing press. Okay, Greece sold their debt for euros, and it turns out the ECB did get recruited to buy it ultimately after the crisis became apparent. Argentina sold its debt in dollars, and they don't have the dollar printing press to bail them out. And the same way with California, and they didn't have the printing press, but that is not a settled issue, and I wouldn't be surprised if we're going to see more about it this coming year. So on the face of it, the problem is taken care of, but now let's reckon some of the cost associated with this. Now, also let's look at the second way to handle the problem costlessly. It's the $1 trillion coin. Basically, you have the same result. I didn't add another balance sheet because I didn't care I didn't care to be dominated by all these balance sheets, but all you have to do is substitute the T's for the Treasury bills and call it a coin. The Treasury produces this $1 trillion coin. It stamps on it $1 trillion. It might only cost $10 of production, but they stamp on it $1 trillion. They sell it to the Fed, and the Fed pays them $1 trillion. At the end of the day, you have the same end result. The coin disappears into the vaults of the Fed, but what's out there is the additional cash. So actually, I don't care what Treasury produces and sells to the Fed. If the Fed will pay $1 trillion for it, whatever X is, it disappears. It doesn't have to be debt. It doesn't have to be coin. Heck, it could be an ounce of dirt, for goodness sakes. So basically, what we have then is the same exact thing happens with coins. You might ask, why did the coin idea come about? Well, it's a result of, the United States might do a lot of outrageous things economically, and indeed that's what we're doing to ourselves. It seems to work in the short run. The long-term costs I'll get to, which are extreme. But what we do, we always do it legally. They're always looking for a legal way to do it. In other words, we don't comply with economic logic and reason. We comply with what the law is, how rational or irrational it is. And the reason the trillion-dollar coin idea came up is we're in the debate right now and discussion of a debt ceiling. So you couldn't continue to sell T's because we're up against the ceiling, but there was no ceiling for coins. And in fact, there's existing legal authority. Third point, under the seigniorage power authority, the Secretary of the Treasury may mint and issue platinum coins in such quantity and of such variety as the Secretary determines to be appropriate. Well, guess who the new Secretary of the Treasury is? It's an Obama aide, and he's going to think of things that are appropriate. It gets us to the same place. Next option. Very quickly, this is the one I like. I'm very surprised they're not going to it, but there are legal reasons they're not going to it. This goes back to the Treasury currency option. This is the Civil War edition. Namely, the Treasury printed money and bought things. As I said, the first thing they bought was they paid soldiers who were on the edge of desertion. It's very interesting, also, legal background. At the time, back in 1862 or 3, I believe. It was either 62 or 3. I think it was the National Banking Act that authorized the Treasury to issue this currency. But there was it was a constitutional issue at the time whether the Constitution allowed the Treasury to issue currency. The Constitution allows them to issue coin, but can you issue currency? So basically, again, an end run around the law, this currency, which is a United States note, and if you think that's antiquated and it's gone away, this is the modern version, some of which you might have in your collection. It looks like a Federal Reserve note, but if you look across the very top of that bill, it says United States note. It is an issuance of the Treasury, not the central bank, but they make it look like the central bank, and it has the same properties of legal tender for all debts, public and private. But getting back to the legal issues surrounding Treasury currency, is since it was a constitutional issue in 1863 when it was unclear as to whether or not that the government had the authority to print currency as opposed to coin, they ended up in the bill calling this exactly what the government would love to sell: infinite maturity, zero coupon debt. So what you're looking at is infinite maturity, zero coupon U.S. government debt that's good for, that also has the property of legal tender for all debt, public and private. Now, if you think this is antiquated, it's not. They still exist. The legislation is still on the books, and the reason, what I indicated in the blog I wrote is that I fully anticipate that we're going to go back to it. The only thing that's stopping Treasury from doing it is there is a legal limit for the issuance outstanding, and they're up against the legal limit. And this is Civil War times, and actually post-Civil War they paid quite a bit off. They bought it back. But the current ceiling established in 1971, the bill is still on the books. And the legal limit for this currency is $300 million. Now, John, I'm not a lawyer, but I'm not sure how you change laws, but I would imagine there's something like errors and omissions, and I can imagine some obscure writer to some 500-page bill, they could sneak in something called, we're going to do a spelling correction on the 1863 Act, and where they put the limit in millions, we really meant trillions, so the M becomes a T. That's all you need. And I can't believe this not would happen. The only question is, would this indeed now fall under the debt ceiling? Because they did style it as debt. So I fully anticipate we're going to go back to something like that. The reason is, if you really get into the situation you got to pay your debt with money, you really don't want to deface the Federal Reserve, because you don't want, because what I didn't indicate is that every extension of the Fed balance sheet with money and buying treasuries, the Fed is a bank, and basically they're adding to the leverage of that bank. And basically you're pushing the Fed into insolvency. Currently, the leverage ratio of the Fed is 50 to 1. If any commercial banks are what's the legal limit now, 10 to 1, I think, and maybe they're trying to reduce assets to, the leverage ratio below 10. The Fed is at 50, and the more debt it issues, the more insolvent it becomes. So by the Fed being involved in this monetization process, what you're really losing faith in is the dollar across the world, Federal Reserve issuance of currency across the world. And don't you think that investors across the world don't notice that? They certainly do. Okay, so here's the Treasury option. I'm not going to do the silver coin option, but that basically the same thing. Now, here's where we're getting to the heart of how today is different from the pure monetizations of the past, and this is the new issue. And because part of my title has to do with currency wars, because this doesn't end at our shores. Basically, part of the Fed expansion of $500 billion a year, as opposed to the normal 30 or 40, is to buy either Treasury debt or mortgages in the open market. Now, who the Fed is buying that from are investors, institutional investors. And to the extent the Fed purchases the other $500 billion from institutional investors, basically, if it's a Treasury, the T goes away, why it's crossed out. For a period of time, a brief period of time, they're sitting there with cash or liquidity, and then wondering where to reinvest that money, as institutional investors do. So that money now gravitates to be invested somewhere in our capital markets, either debt, equity, real assets. And so we're having an asset bubble, and basically the S&P 500 now has a correlation of about 85% to these Fed QEs, as opposed to some kind of correlation or relationship to underlying corporate profit. So we're having liquidity-driven or Federal Reserve-driven asset prices, and this is how it happens. But the most interesting and important one for the purpose of this talk, to get really into the intrigues that lie ahead, is the very bottom asset, is foreign assets. And one of the possibilities for the institutional investor is, if they look across our markets and find them terribly over-leveraged, is to look at other markets that are less leveraged. As a matter of fact, I looked at Bill Gross's monthly statement, or his monthly PIMCO outlook last night. I think 4 countries, Mexico, I can't remember the others, Canada, and 2 other countries, and he's now identifying as the foreign asset plays for him. And that's what investors are looking for, where else to go with it. But then it starts a whole new dynamic. And the whole new dynamic is the new financial market liquidity looks for a new home. And to the extent it goes abroad, and certainly did, like with QE2, and with QE2, which was 2 years ago, a year and a half ago. It's October 2010. It began. A lot of it went to countries, like, for example, like Brazil, that were growing very rapidly. That ends up, what it does is gives liquidity to our institutional investors, head to Brazil. Their Treasury rates were very high in real terms, much higher than ours. And as the funds poured out of our capital market into the Brazilian capital market, it caused their currency prices to rise. Now, if you're sitting there in the capital of Brazil and you're trying to appraise what is the effect of the Fed's QE and the effect of the U.S. government desperately trying to finance its deficits on Brazil, you have both a plus and a minus. The plus is the capital comes in. It bids up security prices. There's a positive wealth effect. Yippee, we're rich. The government gets their share of it, called capital gains tax. But on the other hand, if you look at it and it goes on for too long, they have 2 negatives, which they've seen and been through before. And the first negative is the investors have bid up their currency value to buy their financial instruments. So Brazil now looks at it and they say, oh, that's fine and good to have this wealth effect, but we can't export. And so that's the bad news. The other bad news is it's causing an unsustainable asset bubble in our markets. And countries like the developing countries the last 15 years have had gushes of developed world capital coming in and then leaving. If you remember the Asian contagion of 1997 when it hit Asia. So basically they've been highly sensitized to there's a limit of how much foreign capital we can digest and put to work, and before we end up in an overbuilding boom which leads to a bust. So at first, the news to Brazil is wonderfully positive, but then when you weigh the positive and negative, they say, okay, we've had enough of this foreign capital. What we're going to do is try to shut it off, and they try to shut it off in 2 ways, which has further impacts, which is the next iteration of the chain causation down the road. And the next is, for one, they intervene in the currency market, and intervention in the currency market is another way of saying their central bank, and here's the currency intervention, working its way out. Their central bank, this would be Brazil, sells their currency against the dollar. In other words, you're selling your currency in the foreign exchange market so you get it cheap again so you can export. and they buy dollars. So they offset the appreciation of their currency. And you might say, well, that's kind of a clever financial device, but it has implications, further implications. And actually, for what happens is, that some of them are positive. I'll get to that in the next slide. Basically, they are able to offset the capital inflow impact on the exchange rate so they can continue to export and run trade surpluses. And who do they run a trade surplus against? The United States. So our trade deficit widens, and I'll show you the numbers very shortly in the next slide. But there's another way Brazil can moderate the incoming capital, which I want to get to in the last slide. You not only can offset the capital inflow where your currency appreciates and becomes more expensive by selling it against the dollar, and there's no limit to their selling it because they just simply print it just like we did. And basically, the other way you can do it is to put a tax on foreign capital inflow. And they're taxing foreign capital inflow at the rate of 5%, which is a wonderful boom to the fiscal surplus for that country. And where I'm going to end up with this, just to give you an idea of where I'm going with this, is I guess I'll propose that Texas secede and do the same thing. Looks like a good idea to me. But here's some of the intervention of the implications. It's called a currency war, and now we get the terminology of currency war. What's the dynamic that's occurring is when the Fed prints so much and buys from private investors, and they spread the purchasing power in open global capital markets around the world, foreign currency appreciates, those countries don't care for it. It turns out there are 20 of them that have intervened in their markets to get their currency back down to where it was. It's a mixed bag of countries. It's not just the Brazils or the Chinas or the emerging market countries that are big exporters, but some of the developed countries like Switzerland. It happened, I guess, a year and a half ago, not so much from capital flowing from the US, but from Europe. And the chairman of the Swiss National Bank indicated, look, we got to intervene in the market. We got to sell skis this winter. And basically, we got to keep our exports going. So it's developed countries. And by the way, the biggest one now is Japan just entered the currency wars last month. They're just about to get back into it. So we have others intervening, which are developed countries. They're in Europe, they're in Asia. We have developing countries. And the oil producers are also, or the energy producers, or the commodity exporters are also intervening. So basically this is happening across the world, not just in the Brazils, as you would think. Israel, lots of countries that are developed countries are doing it as well because they want to keep continuing exports of manufactured goods or commodities. So now our money mushroom ends up being equated elsewhere. And so the next slide gives you an indication, and this is in the Bergsten article of suggested readings. It's really, Bergsten is, he was chairman of the Peterson Institute. You know, he has IMF, he has a lot of pedigree and a lot of clout in Washington. These are the numbers he came out with in December. Currency wars work, at least in the short run, because the external balance of the currency manipulators, taking all 20 countries together, they run trade surpluses into the tune, accumulated, of $1 trillion a year at our expense. No, excuse me, other countries' expense as well. Excuse me. They run their net surplus, trade surpluses are running $1 trillion a year. Some of it against us, some of it against other countries. And it turns out that he can measure how much intervention they did because from the Washington's point of view is, you know, in the short run, they might not frown on this. As a matter of fact, George W. Bush did not frown on it and encouraged China to do it. Because as they intervene in the currency market to keep their currency cheap, to keep exporting, they buy dollars. And the question is, what do they do with the dollars? Well, on the left-hand side of their central bank, the dollars they held now get crossed out, and they buy U.S. Treasuries instead. They can't sell dollar-denominated assets or will undo their whole intervention. So they're, quote, stuck with our Treasuries. So that's called foreign sales. It's called external balance of currency manipulation and official purchases. You look under the Treasury numbers, which I did yesterday, to see how much sales of Treasuries went to foreign official sources. Well, it's going to be the foreign central banks that are intervening, and they rather have some interest on U.S. treasuries than just U.S. dollars that earn no interest. But in this case, we have a problem because we get taxed to provide the funding to the U.S. to pay interest to those governments. That's not interest-free. It's not rebated. They don't rebate it, they spend it. They lower their taxes and grow faster. So basically, they're leveraging off us in at least two ways. Now, what has it done to the United States as far as this operation is concerned, as far as the trade numbers are concerned? This starts in 1970 up till recently. These numbers are the end of 2012. And what we're running is about like a 4% trade deficit, which slows our economy down each year by 4%, which means more unemployment. And to the extent we slow our economy down, there's less revenue paid to the government, so our deficit is larger. So it's hard to make any kind of claim that we're benefiting from this. Basically, what we're doing is generating lots of money across the world, and now as investors, we have to think about what happens as a result of that. The U.S. turns away. We don't complain to the WTO. I know Schumer from New York keeps introducing bills to punish China, but he'd have to punish 20 of them, not just China. And basically, it's political posturing. And George Bush would call him up and say, no, 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 we want them to do that because of the proceeds they buy treasuries. What's the matter with you? So anyway, the U.S. turns the other way, and it's happening. All right, now, where do we go with all this? Let's put it together. We have short-term benefits of being able to finance government spending without more taxes to cover debt service. We get this kind of sugar high that everything on the surface seems fine and dandy, but what's really building up below all this is the government becomes more insolvent every day. The Fed becomes more insolvent every day. It adds more debt relative to its capital. And we're inducing not only vast increases of the money supply here relative to income growth, so the ratio of money to income goes way up, and it's happening not just here, but across the world. And this is last seen, I guess, in the 1920s or 30s when countries were competing for the cheapest cost of their goods. And we're trying to, those countries are trying to benefit at our expense, and we're allowing them to do it as long as they finance our deficit. So we're getting in deeper and deeper into a different hole, and we're giving things up on trade. The point is the U.S. money increase is more than matched by foreign money increases and more than matched by foreign commercial banks because for a long time here, and I see a few people in the audience that I taught money and banking to, when the central bank expands, you also have the commercial banks expand with a multiplier. Now, it's not happening in the United States, but it's happening abroad because their commercial banks are solvent and they can expand. So you're not only getting a dollar produced here produces dollars produced there by their central banks, but their commercial banks also expand. So what you're getting is this vast increase in the monetary base across the world relative to goods produced globally. So there's a global money supply multiplier that is very large. I haven't been able to calculate it because I don't know the expansions in all these other countries. It would be a great academic piece, and I'm sure the IMF or the World Bank is working on these things to come up with the numbers because they have the numbers. But basically the worldwide the money supply multiplier is working very differently than when you were students. It used to be the Fed expands, and on average the commercial banks expand at 8.5 times as much. Now the money supply multiplier is foreign. We expand, their foreign central banks expand more than us, and their commercial banks have the same multiplier. So basically the number is going up astronomically. So the question becomes, how do you not get inflation? Because all our intuition as an economist says out of this has to come inflation. Certainly, many in the audience were students during the heyday of Milton Friedman and monetarism, and he was taught that every percentage increase in money relative to goods ends up being inflationary. And guess what? It's not happening right now, and so there's a lot of new work being done. Like, why not? And basically, the why not is the money is being produced here. And we have such a depressed economy that we have such excess supply relative to demand. It's not until this excess money gets the demand up to our supply capacity that we start to get the inflation out of it. But where the inflation is going to occur faster are these other countries because they're nowhere near as depressed as we are. So we're going to end up importing their inflation in the first instance. How far away? Well, the latest number I see from Dave Rosenberg, I'm not sure if any of you went to my June event at the AT&T Center, and Dave Rosenberg should be a familiar name to some of you investors. He puts global slack at 3%. He was one of my speakers there. Global slack at 3%. So you got to, and global resource, it's a moving target. So the demand has to catch up to the moving target of supply. But with this level of money increase worldwide, it's going to do it. The only question, how long? My best guess is, and I think I have two guesses in these PowerPoints, 2 to 3 years, I say, something like 2 to 4 years before it catches. In the US, we have slack of maybe 6%. I think my November blog really put the number more like 5%. We're having a terrible thing happen in the United States. The level of new investment spending is growing so slowly that our capital stock growth is slowing down enormously. So our capacity, you can't take the old numbers and extrapolate them forward because it's not happening. And in two ways, our labor force is not growing at the rate it used to, and our capital stock is not growing at the rate it used to. So we're going to use up our slack quickly, but the rest of the world's still growing, but their demand is closer to their supply. I would say 2 to 4 years before it all starts catching up. It's already catching up in Argentina. If you notice this week, they put on price controls on food, but Argentina is another story. All right, so the cost of the QEs. It might seem on the surface as solving our problem, but really has major costs. The currency war causes the U.S. to continue to lose in trade. We have 3 to 4% less growth than we should. As I said, our current growth rate, or last quarter, was negative by 0.5 point. We could be having a 3% growth rate, which is pretty decent, have we not been put ourselves in this position where we need the financing of our deficits. So we're having that kind of loss. It's probably 3 to 5%, 3 to 5 million unemployed. The economy stays sluggish, piles up larger fiscal deficits. But the good news in Washington is a victory, because the bottom line is the bottom bullet point. The Social Security checks keep going out, and that's all they care about. And they don't see what's happening, and what's really going to happen is the long-term pain. The fountainhead of money comes from the U.S. It gets multiplied abroad. The treasuries are now being purchased. On the surface, it all appears relatively fine and dandy, especially if you're in Texas, because we do have a positive growth rate. Elsewhere, it doesn't seem so fine and dandy already. But the currency intervention will end up having investment ripples and effects. The question is, where does capital gravitate in a world of mutual inflation? And currency wars imply the world is going to look for an alternative reserve currency. Basically, if you read Bill Gross's latest piece, and I certainly recommend you all do it, as far as I'm concerned, he's the #1 spokesman out there for what you should know and what you should be aware of. And basically, I read it last night for his February edition. Basically, it's this, except he gives you some clues where you're going. And the question, if you have mutual inflation everywhere, you start to look for what? Real assets, or you're looking for a currency that's not going to inflate, or a country and currency that's not going to inflate. So basically what we have is really an incredible wild card situation. It's the wild card opportunity. Here it is. The world will be seeking, i.e. investors with their capital, will be seeking a currency that's not inflating. And the question is, who is that going to be? That has rule of law, that we have some confidence in. And I put the leading candidates, the bottom, reserve currency candidates. To me, it's UK. I think the UK is setting themselves up to be, once again, the world reserve currency. They're going to put to the voters to pull out of the EU. They're not in the Eurozone. They've stopped their QEs, and they've just hired the chairman of the Canadian Central Bank to be their central bank chairman. First time, unprecedented. We took a foreigner. Why? Because he's running the Canadian Central Bank without any of these QEs and understands the game. So they hired a foreigner, which is for British, that's way over the top. So there's, in my opinion, they're setting themselves up and understanding that, and they're probably large enough, and they certainly have a history they do have a fiscal problem like this. But remember, if world capital comes in, you take the Brazil model, you tax it, and then that gets rid of your own fiscal problem. So that's a phenomenal opportunity. And I think the UK understands it. Canada is a conceivable possibility. I say China because they're certainly making moves and discussing, and it's not so. What they've been doing is they have an embargo on the export of gold production of China, which is the highest gold production of any country in the world. And if China is going to get into the game as a world reserve currency, the only way the Westerners would probably do it is if it's convertible to gold. Rule of law, we still would have problems with China. So China's trying to set themselves up. So other countries, and it's going to be difficult because the United States, to be the world reserve currency, you have to have, it has to be a very large market to be liquid, sufficiently liquid that you can put large quantities of funds in and take them out without rippling the prices. So it has to be a relatively large base, and it might take several countries. So but in any event, the question is, where do you go with this? And people are trying to position themselves and trying to figure out what their risks are. And investments is a matter of looking at the risks, appraising them, and trying to avoid them. So that's what the world is doing right now. We've hit the outer limit of demand-side policies. We're not choosing the Romney path, which is instead of papering over this with Federal Reserve money and spending, the Romney path would have been trying to grow your supply base. We didn't take that path, so we're still in the demand side path. I think things are going to get out of control. We're probably in for boom-bustology, which means asset price bubbles. But ultimately, citizens flee paper currency in general. And it could be not only us, but the other countries that are also inflating, and which is going to be an interesting dynamic. It's conceivable that some other foreign countries will inflate more than we do, and we'll look like the solid country by comparison. So it's a little difficult at this point to see how this is all going to work out, except that we know the countries that are on a course to inflate, and since we're not willing and able to face our fiscal deficits, we're certainly going to be among those. So the question becomes, where do you gravitate with world capital? And this is the big issue today. How do you protect yourself from these risks? And the risks are inflation. The risks are wealth taxation, because income taxation is not sufficient. And wealth taxation is broken out in Europe. There are 3 countries now that have wealth taxation. And the issue is, can you find assets that are resilient to this, or more so than others, and the world will gravitate to those. The United States understands this. It might shock you to realize that one thing about Washington that they don't tell you, they realize these things are happening. They're already putting in place barriers to capital outflow, and they're trying to, and right now you can't be the world reserve currency if you have capital outflow restrictions. So they want to still be the world reserve currency, but to the extent this causes you to leave the country with your capital, they're trying to keep track of where your capital is. As of last year, I hope it's not news to anyone in this room because the fines are extreme. If you have more than $10,000 in a financial account offshore, you got to report it to the IRS. Failure to report is what, I think $10,000 a year fine, I believe it is, Keith? I think it is. It's a very large fine, particularly if it accumulates. In fact, there are 2 reporting forms. They want to know where your money is. That's not in the United States. Never had that before. Why are they asking? Because they know people are leaving. The other thing, I think it might come as a shock to you to realize that there's something called an exit tax. If you decide you had enough and Australia looks better, or wherever, whatever your taste is, and you decide to pick up and leave and turn in your citizenship at the U.S. consulate in that country and get another passport, there's now an exit tax. Basically, the government considers you dead, and you have to pay a state tax. As far as they're concerned, you are dead, and we want your share. So basically, they are ramping up the taxation network of capital fleeing because they realize that's where these policies are going to go. So this becomes now a major, and that's already started. And the avenues of your ability to somehow manage your own risks within the context of these new constraints is becoming a growing problem. And as a result of this, I'm putting together a group of local trust and tax attorneys and accountants and financial planners to give us the latest take on what seems to be a reasonable investment alternatives, and either in the United States or abroad, as for your own personal protection. And basically, as I say, I hope this is not news. Bill Gross is writing about it very candidly, so I guess I can be candid about it as well. And I anticipate I'm going to be giving I think in May, a talk sponsored by Texas Enterprise, and that's in May at the AT&T Center. So if you'd like to be included in the guest list, outside by the registration, there is a place for you to leave your card, and we'll make sure you get an invitation. And I anticipate to continue the Spellman Report series. I rent a room in the AT&T Center about once or twice a year if something's worthy of discussing, and provide a lecture. I hope at my next one, spring or summer, that I'll bring along with me some very qualified attorneys, international trust and tax accountants and attorneys, to give their take as to what the current options are. And that's basically where I'm gravitating. So if you want to be included, leave your name. We'll have a sign-up sheet out front. And where's the Keith? It's out by the registration? Oh, you have it? At the registration table, thank you. Okay, as I say, I think the day is May 8th, but I'm not sure about it with the Texas Enterprise discussion for which I'm on the program, and I'm sure by then I'll be gravitating in that direction with clearer indication. So that is it, folks. It's not a pleasant story, but there are options and you got to seek them. And that's it.
Right.
He's going to stay if anyone wants to approach him.
But one or two questions, just in case somebody has a burning need to say, Lou, where is the next cave? Madame.
There's a microphone, if you would, so everyone can hear you, particularly
Dr.
me.
Spellman, it's good to see you. Could there be any possibility of deflationary forces?
Yeah, that's the most interesting question of all. Some very, very prominent economist, and one who appears often on my website, the Spellman Report. By the way, it's subscription free, I forgot to add. It comes about once a month, so it doesn't jam your inbox. But I do frequent interviews at least once a year with Lacey Hunt, and there's several other people like Gary Schilling, who are, and Dave Rosenberg, very prominent names in the investment world, who are very much in the camp of thinking we have deflation ahead, not inflation. And I know of no issue that separates very qualified, learned people. Now on the other side is Bill Gross and me. The only question is when. Or John Malden, who I also had at my June event last year, who some of you might know or know the name of. When John is asked deflation or inflation, he loves to say both and wait for the appropriate chuckle. And then after the appropriate chuckle, it's deflation at first, inflation later. Basically, the deflationary forces are we have excess supply right now, and we have a depressed economy in the U.S. So the U.S. is having trouble pulling off the inflation that you'd expect. I would expect I'm glad you asked the question because I really didn't make clear. Where the inflation is going to come to us in the first round is from buying products from Brazil and the Switzerland, and it's become in the form of imported inflation. And then when their goods become more expensive, then our trade deficit improves and they buy our goods until we have excess demand everywhere. So I would think that's 2 or 3 years down the road before we're going to see it. And when we had QE2, when we did this, and before Brazil was doing their intervention and their currency would become more expensive, as we translated dollars into their currency to buy their goods, we had import inflation. It was enough to get our inflation rate to 2 or 3%. I mean, in the 70s, we got up to double-digit inflation on import inflation. So we'll get there, but that's going to be the route this time. It's a different route.
Thanks, Lou.